everybody. I'm Jerry Cronenberg, Director of Financial Content here at Moo Technologies, Inc. And I'd like to welcome you to our latest webinar with Stephen Sarge Guilfoyle, our markets commentator here at Moo. Good morning, Steve. How are you today?
Oh, I'm pretty good, Jerry. Thank you for asking. And welcome to all you out there in TV land.
Yes, welcome as well. Well, Steve is going to help us today talk about ratios, specifically price to earnings ratio, price to book, price to sales, etc. Now, everybody hears this on financial news, but admit it, you don't know what all of them mean. But if you watch this entire video, you should have a pretty good idea with Steve explaining it to us. Now, Steve is our markets commentator here on Moo. He is on the Moo community each and every markets day under the handle Invest with Sarge. Check it out, see what he has to think about the markets, and you can ask him a question during the week, not just during these videos. Today, though, he is going to talk, and we're going to talk about various ratios. Now, Steve knows a lot about this because he is a former New York Stock Exchange floor trader, a former staff economist at various firms, and is a current columnist for the Street.com Pro. So we're going to have a great discussion. Now, before we get started, I'd like to remind everyone this is an interactive video, so please ask us a question if you have one for Steve in the chat group of this or the chat function of this discussion. And if you complete a question for us, we will give you 100 Moo points just for doing that. If we use it live on the air, we'll give you another 1,000. And even if we don't, you should check out Invest with Sarge this week. He will try to answer any that we do not get to. So let's get started right now. By the way, I should mention his nickname is Sarge because he is a real former United States military sergeant. All right, let's get started, Steve, and talk about ratios. Again, these are used all the time. People hear them, but not everybody knows what they are. So let's start with the probably most common one, which is the P to E or price to earnings ratio. I want to talk a little bit about that and the difference between the so-called forward P to E and the trailing P to E or TTM or trailing 12-month. What are those and how can you use them in your investing journey?
Yeah, basically, price to earnings ratio is really just the market cap of the firm divided by the amount of shares that the firm has outstanding, or rather in the float more than outstanding. So it's really straightforward. It's just how profitable is the firm and divide that by how many shares are out there, and that you come to a PE ratio. When I started out, I'll talk about forward PE ratio. That's Jerry mentioned forward PE and ratio and trailing PE ratio. Forward looks out 12 months, so it's based on estimates. It's the estimated earnings going out over the next year. Trailing is over the past 12 months. So it's fact. It's not fiction. It's fact, but it has almost no bearing on the stock going forward. So in almost every case, will look at forward earnings ratios because the market is supposed to be a forward discounting mechanism. The market is supposedly priced 6 months in advance. So that's how I, as a trader and an investor, like to look at PE ratios. I find the trailing PE ratio is good for doing some really in-depth analyzing of different stocks, different sectors. But as far as trading and trying to make money goes, I think the forward-looking PE ratio is much more important.
Now, it's funny, I look at that too, but I would just caution folks, if you go on a stock quotes page, unless it specifically says forward P to E, it's probably going to say TTM, which is trailing 12-month. And so that's something to check out. Also, Steve, there is only one trailing 12-month ratio, PD ratio, because the numbers are known, but I believe there is not just one forward because it's based on an estimated earnings against the stock's price, and different people have different estimates. Is that correct?
Yeah, that can be. It's usually based on the consensus. And if you follow a number of different financial websites, you'll notice that they almost all have a slightly different consensus for different stocks, different companies. So the PE ratio might not be represented exactly the same way on your Moo account as it is, say, at Dow Jones or at any financial site that tracks these things. So you'll get a general idea, but you probably, from really good information, you probably want to rely on somebody like FactSet or Refinitiv. I forget who it is. They changed their name recently. But you want to rely on somebody like that who's supposedly not biased, not trading, and just data compiling type service like that. So I usually lean on FactSet more than anybody else. But you can lean on Ed Yardeni's website. There's a number of websites that you can go to, and hopefully, in most cases, unless you have a stock that's really lightly followed, so there's only a few analysts, the consensus will usually be pretty close to each other.
Okay. And just by way of an example, so what you do to calculate a P to E is you look at the stock's current price. Let's say it's $10 a share. and then you look at its earnings per share, which comes out every quarter. I believe they annualize it. Is that correct? Let's say it's $1 per share, or how does that work? Do they just look at the one quarter's EPS, earnings per share, or do they
I
multiply?
I think they update it every quarter, but
Right.
like you said, the outlook is a year forward or a year back, but a year forward. So there is an annualization aspect to it,
Yes.
but they will update that more than every quarter. Actually, they'll update it every time an analyst changes his mind about his forward-looking projection.
Okay. And you wind up with a number that is typically between 0 if they're losing money, and probably less than 100 in many cases, not all cases. And by way of reference, I just looked it up today. The trailing the trailing PDE on the S&P 500 happens to be around 22 last time I checked. So let's talk a little bit about that too. Is that, let's say that again the S&P 500 is 22, and I'm looking at a stock that's 80 PDE. What does that tell me? Again, we're comparing apples to apples, trailing to trailing. It's
Yeah,
expensive stock, right?
if you go sector by sector, you'll see that different sectors have different averages. The S&P 500 trades at an average right now of a little over 20 times forward-looking PE. But if you go sector by sector, you'll see some as high as 28, 29. You'll see others down around 12, 13. If you see a stock that trades at an 80 or just so far above the norm, it's probably a growth stock. They're pricing in future sales, future cash flows. And if there's something that seems undervalued, well, then you have to wonder why. Is it truly undervalued? Is this a great discount? I've been fooled myself many times, especially when I was just learning the ropes trading. Oh, this thing trades at 6 times earnings. This is going to be a layup. No, it's not going to be a layup because they know more than you do. And if something's trading at 6 times earnings, that probably means that they're headed to go over a cliff. They're headed for something negative. Like the semiconductor industry is great for this. I mean, the ones that are heavily involved in AI, like NVIDIA, they trade at a much higher PE than some of the other ones where Micron, which they sell memory chips, which is basically trades like a commodity. So the memory chip stocks will right now they're starting to regain favor a little bit, but when you go back over time, the PE ratio is so volatile for these kinds of chips because they're a real cyclical. There's real cyclical demand for these things, and now with the rise of AI, the rise for memory is there as well. But let's say the semiconductor stocks that are not so successful at developing their artificial intelligence program. Let's say like Intel. Intel relies more on the PC market, and they're trying to get into the foundry business. These are lower margin businesses, and these are not really growth businesses. So Intel is afforded a lot lower PE ratio than NVIDIA or AMD, which has not really been successful yet in garnering that AI business, but they're trying to crack that market. So they have been, even though they've come in a bit of late, that stock has been afforded a higher PE ratio than many others in its space.
Right. And so that's one way you can use a PDE, right? I mean, you may want a growth stock, you may want a value stock, but if something has a PDE of 80, that is probably a fairly expensive stock relative to its earnings. Whereas if it has a PDE of 4, maybe a great deal, maybe a terrible deal, but that's a pretty inexpensive stock. So that's one way to use PDE, right?
Oh yeah, and a lot of these stocks that trade with really high PE ratios, and it's probably a ratio you're about to get to. They'll trade in terms of sales, so it'd be P per sales instead of per earnings,
Right.
and they'll trade so many times sales or so many times book rather than no one really looks at the PE ratio. And or let's think of a stock like Tesla right now. All right, I'm not in
Right.
Tesla, so I can speak about it. The Tesla has a very high PE ratio, but the earnings are coming in fast. The forward-looking earnings are coming in fast. They just had a lousy quarter. They're supposed to have another lousy quarter for the current quarter.
Mhm.
Right now they're not justifying their high PE ratio, and you're seeing that stock pay the price of late. They had a little bit of a rally last week, but I think yesterday they got hit for about 3%. And that stock has always been speculative in nature, but right now I think it's more speculative than ever. And I hear a lot of talk of people shorting the name, where I used to hear people mocking the people who were talking about shorting that name. So the pendulum has swung on a stock like that as the sales have swung.
Great. And just by way of a pointer that Steve, when he gives his opinions, they are his own personal opinions. They may not apply to every investor. Depends on your financial circumstances, your risk tolerance, et cetera. So go ahead and do your research. Now let's move on to another ratio when you talk about high growth stocks. There is something called the PEG, P to E to G, price to earnings to growth. Why don't you talk a little bit about that and how that plays into investing discovery?
Yeah, it's the PEG ratio incorporates growth into the PE model. So it's really the PE ratio divided by growth, basically. And like with regular PE ratios, each each group, each sector, each industry has their own norms, and you have to measure the stock or two that you're in against those norms, and then you'll know if something is, in your view, overvalued or undervalued. When a PEG ratio comes out to, let's say, below 1.0, it would often be considered undervalued if there's no significant change expected to future earnings. Above 1.0 would be expensive. Palantir trades at a PEG ratio of over 2. Okay, so we saw nice growth from that stock yesterday, but not superhuman growth. It was basically growth that had been expected, and they didn't disappoint really. I mean, they disappointed on guidance just a touch, but they didn't really disappoint on growth. But the stock came in almost 15% because it's an AI stock that's growing at really what it always grew at. It's not, the growth has not really accelerated yet because it's implementing AI into all of its platforms. So it still has a high PEG ratio, but yesterday was a blow to the stock, and you may have taken advantage of that, or you may have taken advantage of this to get out of the name, because the name is up a couple 100% over the last couple of years.
Okay, great. And again, Steve's personal portfolio may or may not fit in with yours. But let's talk about the PEG ratio a little bit more. Price to earnings to growth. So we know price, it's a stock price. Earnings is earnings per share. How do you measure growth and factor that into calculating out a PEG ratio?
It's growth. It's growth rate. It's if something's growing in sales at 20%
Okay.
over year on a regular basis, well,
Okay.
that would be your denominator, and they would basically take the PE ratio, divide it by the growth. I'm not sure exactly how they do the formula, but compare that to the other stocks in the same sector. And as I said, 1.0 seems to be the divining rod, as like with a PMI or manufacturing survey, where 50 is the
Right.
divisor between growth and contraction. Well, here 1.0 seems to be the divisor between overvalued and undervalued.
Okay, good. Great to know. Now let's talk about two others, one of which we already touched on: price to sales, or P to S, and price to book, or P to B. Why don't you explain those and how you can use them in investing?
Yeah, well, price to sales is pretty straightforward, I think. But a lot of times when something's trading so overvalued by traditional means, they'll talk about times sales instead of times earnings, because times earnings might be 500. So times sales, if that's more something that won't scare investors away, they'll talk about trades at 25 times sales, 26 times sales, because the stock's growing much faster technically than it can fundamentally. So it's basically just a way to get around talking about price to earnings, because the earnings haven't really kept up with the stock price. Price to book, it's the book value. It's the book value of the stock. I like tangible book myself more than regular book, but that really matters for the banks, I think. But tangible book removes things like goodwill and other intangibles such as brand names, stuff like that, from the value of the company. So if they had to sell the company for its worth right now, then that's your price to book. That's your price to tangible book. If you exclude all those intangible assets. Now you look at a stock like Disney, which reported yesterday. That's obviously a brand name that would be entitled to a high valuation for its goodwill or for its intangible assets. But you take something that's unknown, and when you look at the balance sheet and you see they need a lot of goodwill, they need a lot of intangible assets to make their assets meet their liabilities, and it's a stock doesn't really have tremendous reason for it, let's say a J.C. Penney or something like that, then something's wrong. Then something's probably wrong with their balance sheet, with their assets, because they have to use something that doesn't hurt if you drop it on your foot. Intangible assets don't hurt if you drop them on the foot, because you can't touch them. For Disney, I don't know, their characters, their the whole idea, their movies, those are intangible. But for something like J.C. Penney, because I mentioned them, and I think that I'm not even sure if they're out of business at this time, but if they were to use a lot of intangible assets to make their balance sheet work, that would be problematic, because what they are is a retailer, and what their tangible assets are going to be the land they own, if they own land, and basically their cash balance and their inventories, and that they shouldn't really have too many other assets besides that.
Right. And intangibles, as you say, are goodwills. If Disney was up for sale tomorrow, the name itself is pretty well known, and that has some dollar value. It's difficult to put a number on it, but that's what
And
we're
they have a
talking
pretty
about.
lousy balance sheet now that we're on Disney. That's for another story.
But we'll talk about that one some other time. Let's talk about two others that you like. One is called the current ratio, and one is called the quick ratio. Whichever one you want to talk about first. What are
Well,
those, and how do you use them?
they're closely related. Basically, it's for balance sheet nerds. It's for people who do fundamental analysis. If you're just a trader, a short-term trader, and you don't bother with fundamental analysis or economic analysis, well, you probably don't need to know this stuff. But if you're someone who goes through the health of a company because you're investing with a plan over a decent period of time, current ratio is basically the firm's current assets divided by its current liabilities. It's as simple as that. Uh, Quick ratio is you remove inventories from the equation. It's basically the same equation without inventories, because sometimes inventories are worthless and they might have them on their balance sheet at what they paid for them. Let's say, I don't know, let's say semiconductors. We use that example again. Let's say Intel hasn't been able to sell all their semiconductors and they have a certain valuation for their inventory, but that inventory, some of it's 2, 3 years old. It's not even good in today's world. So it might be worthless. So if they had to liquidate Intel today, quick ratio gives you a better idea of what you can sell the firm for based on all the hard assets it has, less those inventories, because those inventories might be worthless. And current assets would be things like, besides inventories, like cash position, accounts receivable. Current liabilities would be accounts payable, debt owed that comes due in less than 12 months, lease payments that you're required by contract to pay, those sorts of things.
So that's current ratio. Do you divide that by anything? That's actually not a number I follow. Quick and current to get a ratio, or is it just
They're
how do you
standalone.
calculate it?
They're standalone, and you can look
Okay.
on. You can adjust them yourself a little bit. If a firm seems a little out of whack and you don't think those ratios are as high as they should be, you got to remember that deferred revenue is recorded as a liability. Now, it can be a current liability or a long-term liability, but it's recorded as a liability, and deferred revenue is not a true financial obligation. It's an obligation of goods or services owed. It means somebody paid for something in advance. So let's say Salesforce sold a platform to somebody, but they haven't delivered the platform yet. So that until they deliver the platform to even up the balance, it's recorded as a liability because they haven't lived up to their side of the bargain yet. Once they deliver, it's wiped out. So it's not. Often I will when I write an article and I'm analyzing a stock for folks, I will also include an adjusted. Now that's my own thing. That's not something common in accounting. My own adjusted current ratio and quick ratio to give people a better idea of what's really on the book outside of deferred revenues. Because unless you're unable to deliver, those deferred revenues should never count against a firm's financial health, because that means they have order flow. That means they have customers already.
Okay, great. Well, let's go to some questions. Please feel free to submit one now. Let's start with some that we got in advance of this conversation. First one is from our friend, Mr. Cash Cow. All right, how do we figure out and determine what is a good price to earnings ratio? Now, we've talked a lot about how you calculate this. Of course, this is subjective, but can you give some guidance without any real specifics on good versus bad? I mean, do you benchmark it against the S&P 500 or others in the same sector? I mean, why don't you give a little thoughts about how someone might calculate that?
Well, good is going to be, you're going to have to take a leap of faith on what's good a little bit, because good might mean undervalued, but undervalued might mean that it's not, that something bad is coming down the pike and the public hasn't seen it yet. So a low price to earnings ratio rather than good, or you might say, or a high price to earnings ratio, because some growth firms are able to maintain elevated price to earnings ratios for years without ever coming back to earth. So the average price to earnings ratio right now for the S&P 500 is a little over 20. When I was young, a little younger, it was around 15, then it was 16, 17. It seems to be going up over time. And that's probably due to all the quantitative easing and easy monetary policy we've had over the years, that with money being so liquid, with capital being so liquid, that more of it has found its way into the stock market. I think that's more a function of that than actually better business practices or anything else like that. So I mean, you can go I'm going to look at something for this call it right or right now. Let's see here, the consumer discretionaries are currently trading at 24.2 times. S&P is at 20.4 times this morning. But if I just flip down to the financials are trading at 15.1 times. So if you're trading a financial stock or a discretionary stock or whatever sector your stock is in, it matters much more to you what the sector trades at than what the S&P 500 trades at.
Right. These are S&P 500 sectors you're looking at. There's 11.
These are right. There's 11 S&P 500 sectors. You can track them through the sector spiders. Almost every financial website posts like a daily performance table. It looks like their standings, and you can look at them over the day. You can look at them over the month, over the 3 months, so year to date, and probably go back as far as 10 years.
Okay, great. Next question from Aaron 39. When do we use P to E, P to B, P to S, and like in assessing stocks? Can we use just one, or should we use all three? What are some thoughts on that?
You should always look. I think you should always use P to E. I think that's the standard. Okay, forward-looking P to E is my personal opinion. Okay, that's the one that I look at no matter what. With a growth stock, I'm probably going to look at price to sales as well, if it's something in the communications sector or the technology sector. And price to book always matters, and I'll always look at it. But I follow it probably more closely with the banks than any other group. And I like to look at price to tangible book as well if I'm looking at price to book, because as I mentioned, I'm not fond of firms that rely on intangible assets to boost their balance sheet. So I will look to see if price to tangible book is that much different from price to book.
All right, great. Next question is from Wonder. How do you know which valuation methods are more suited for different industries? Which combinations of measurements work best? Of course, we can't talk about best. And the last part of the question is, for instance, with tech companies, is DCF, or discounted cash flow, preferred? So, of course, it's up to the individual to decide what to do. Steve doesn't know your whole financial situation, but why don't you talk a little bit about how these fit into different industries? As you say, I mean, financials versus tech versus something else, you're probably looking at different factors.
Yeah, I think with tech groups, as that seems to be what this individual is interested in, I think forward-looking PE and PEG ratio are obviously going to be important. And I think cash flow, just regular old-fashioned cash flow. Look at the statement of cash flows it comes out quarterly when they report their earnings. You'll see operating cash flow minus capital expenditures. See if there's any other hair on it. Sometimes there's other things on it that don't normally belong on a statement of cash flows. If it's clean, it's just operating cash flow minus capital expenditures equals free cash flow. Compare to free cash flow, not just to the quarter prior, but to the same quarter a year ago and to the same quarter 2 years ago. See if there's significant changes, because a lot of these firms have certain seasons, not even just cyclical stocks, but they have certain seasons where certain buyers come up for renewal every year or every couple of years. So they definitely have strong quarters and weak quarters. And if your 12-month trailing free cash flow is growing or at least stagnating at a decent level, well, then I think you have what might be a winner on your hands. I will also often look at free cash flow above everything else in the instance of a stock that's more difficult to rate according to the other fundamentals.
Okay, great. Next question from ZNWC, two-part question. I'll do the first part now. All right, for a big market cap company, is it fair to compare the P to E ratio with a small one, i.e. a startup? Why or why not? Any thoughts on that?
It's probably not fair. With a startup, I think you want to see revenue. You want to see that they can drive revenue. So you're going to be looking at price to sales probably more than PE. It's nice if they have PE. It's nice if they have earnings, but you're not going to demand profitability from a startup right away. You're probably going to look at more, do they have a product that sells? Do they have more than one product that sells? And do they have moats? Do they have some defensibility if their product is unique, that next year at this time there won't be 4 other larger companies that copied them and put out a similar product? So what's like that, like GoPro's they were unique for a short time. Now, even if you call it a GoPro, it might not be a GoPro. There's a number of brands that sells a camera that you can stick on your helmet or whatever the heck it is when you're doing crazy things that might get your arms broken. And basically that's my GoPro didn't have a moat, so now everybody copied them, and GoPro is no longer such a highly valued stock. But that's where you go with that.
All right, great. And the last part, for companies like Tesla and Meta, which have a very high share price and reinvest a major portion of their earnings to growth, like research, do you think a high P/E ratio is a risk or an opportunity? Now, of course, you don't know everyone's portfolio, so it's going to be an individual decision, but make a case that a high P/E in a big, well-known Mag 7 stock is a risk, and make a case that it's an opportunity. Or what do people do
Yeah.
to decide whether a high PD in a big stock is a risk or an opportunity?
Well, Meta, I don't think they have such a high PE ratio right now. And Meta got hit this time around in the earnings. But as you know, Zuckerberg is really, he definitely seems committed to what he's doing. He's reinvesting in the business, and that I understand. As I'm not in Meta right now, but I'll tell you what, I am considering being in Meta, because I don't really like the way he runs the company all the time, but I do like his commitment and his belief in what he's doing. So I think he's going somewhere. Tesla, on the other hand, as I told you a little earlier in this program, I'm not sure right now. I really think that high PE ratio might be an anchor tied around their feet at the moment, because unless they can turn things around and show more deliveries for the second quarter, if they show another quarter where the stats don't look so good, and Elon is still trying to play the robo taxi game, which I don't think they're that close to, then they might run into some trouble. I mean, technically, the stock looks like am I allowed to say what I think about where the stock might go? I don't know. Maybe I shouldn't do that on this program. But I'm not nearly as optimistic about a stock like that, where you have a high PE ratio and sales look troubled for the moment.
Now, here's a good question. Is there a quick way to spot when the P to E, the P to B, P to S, PEG, et cetera, are unrealistic or manipulated? Very interesting question there. Any thoughts on that?
Well, if the manipulators are talented, no, it's not easy to tell. That's been a problem since the first days of Wall Street. Now, if they look out of place, yeah, I guess you can. It's good to second guess them if you're that educated on that stock and where it should be or where its competitors are. Then of course it's good to second guess what you're looking at. But there's no. The question is there a quick way? No, there's no quick way. This requires some real homework that we probably require a lot of time to spend just on one stock. And if you're a trader who has to show like a certain P&L every day, maybe on average, then you probably want to skip the ones that require a lot of fundamental work like this, and try to move on to your next target or your next opportunity. If you're a fundamental trader and you have second guesses about a stock that looks like it might be manipulated, I mean, keep it on your watch list, but you don't have to commit capital. Or you can sell puts so you're exposed, so you get paid to put yourself at risk at a lower price. I mean, maybe they're naked puts, maybe they're not, but you're at least, it will be a discounted price if you get hit, and you'll be paid to wait instead of just laying out the capital. Sorry.
Great. All right. Next question. This is a good one too. What are the limitations and drawbacks of relying solely on stock ratios like P to E, P to B, P to S in making investment decisions? And how can investors mitigate these limitations? Any thoughts on that?
Sure. I mean, yes, the numbers don't always tell the whole story, and you can mitigate this by listening to or reading the earnings calls when they come out with their most recent numbers. There's almost always an earnings call that you can listen to or read. I like to read it because I miss things on the earning call because I'm usually working while I'm listening. But I will usually read the transcript if it's a stock I'm actively in or invested in or very interested in, and I'll go over some sections. If the CFO says something, I'll go over what that CFO said 3 or 4 times, or what the CEO said. If I think the CEO is the dominant player at the firm, I'll go over what they said 3 or 4 times, and I'll look down through the transcript, because these things are readily accessible. You can get these transcripts, and I'll look for I know who the analysts are. I know which ones I think are good and which ones I don't think are so good. And I'll skip right over the analysts who I don't think highly of, and I'll look for the ones that I know have made me money in the past. And I'll look for what kinds of questions they're asking. And if they're asking it, then it's probably important for me to pay attention to. And then I'll see what the CFO or CEO of the firm said in response.
Okay, well, great thoughts there. We are out of time. Thank you for everyone for watching. Steve will try to answer some questions we did not get to at the Invest with Sarge column on the Moo community. So come check it out, ask him a question on other topics. He will try to answer them as he can. And join us at this time next week for another live session with Steve. Steve, thank you for joining us today. And
Thank you.
to everybody, we're getting right as we speak live to the market open. And happy investing, happy trading. Thanks for watching. Check us out every day on the Moo app. Have a great trading day, everybody. Bye-bye.